Hey there, welcome back to our channel. Today, we're diving into fintech. Ever wondered how the super rich just seem to get even richer, no matter what the stock market is doing? It's pretty wild to think about, right? A huge part of that secret often comes down to something called a hedge fund. Today, we're pulling back the curtain on this super exclusive, often mysterious corner of the financial world. Think of it as a private investment club for the wealthy. It pools money from accredited investors. We're talking people with high incomes or a net worth over $1 million, and institutional giants like pension funds. This pool of cash is then managed by a professional fund manager who uses a whole arsenal of complex strategies to try and make money. Unlike your standard mutual fund that mostly just buys stocks and hopes they go up, hedge funds are all about flexibility. They aim for what's called absolute returns, meaning they try to profit whether the market is booming or busting. So how do they do it? The secret sauce is in their strategies. A classic one is long-short equity. This means they buy stocks they think will go up, which is the long part. But they also bet against stocks they think will go down, which is the short part. By doing this, they're hedging their bets, trying to make money from both their good and bad predictions. Other funds might use a global macro strategy, making big bets based on worldwide economic trends, like changes in interest rates or currency values. Then you have event-driven funds that pounce on company-specific events, like mergers or bankruptcies. This freedom to use advanced tools like leverage, that's borrowed money, and derivatives, allows them to make moves that are off-limits to most regular investors. Of course, with great potential returns comes great risk. Hedge funds are famous for their high-risk, high-reward nature. The use of leverage can amplify gains, but it can also magnify losses, sometimes wiping out more than the initial investment. Another key point is that they are lightly regulated. This means less oversight and fewer protections for investors compared to, say, a mutual fund. There's also liquidity risk. You can't just pull your money out whenever you want. Most hedge funds have lock-up periods where your capital is tied up, sometimes for a year or more. Even after that, withdrawals might be restricted. So who's running these financial powerhouses? You've probably heard some of the big names. Bridgewater Associates, founded by Ray Dalio, is one of the largest in the world. Citadel, led by Ken Griffin, is another giant known for its sophisticated quantitative strategies. And then there's Renaissance Technologies, a highly secretive fund started by a former codebreaker, which is legendary for its incredible returns. These firms manage tens or even hundreds of billions of dollars and have a massive impact on global markets. Now let's talk about the price of admission. It's not cheap. The standard fee structure is famously known as 2 and 20. That means the fund charges a 2% management fee on the total assets every year, plus a 20% performance fee on any profits they generate. So if a fund makes a 10% return, the managers pocket 2% of that on top of their 2% management fee. This structure incentivizes managers to chase high returns, but it also makes hedge funds a very expensive way to invest. How does someone even get into a hedge fund? First, you need to be an accredited investor. In the U.S., that generally means having annual income over $200,000 or a net worth exceeding $1 million, not including your primary residence. The investment minimums are also steep, often starting at $100,000 and easily running into the millions. Access is usually through private placements directly with the fund, through a high-end financial advisor, or via something called a fund of funds, which is a mutual fund that invests in a portfolio of different hedge funds. In a nutshell, hedge funds are exclusive, high-stakes investment vehicles that play a different game from the rest of the market. They use complex strategies to chase high returns in any environment, but they come with significant risks, high fees, and are only accessible to the wealthiest investors. They are a fascinating and powerful force in the world of finance. Thanks so much for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the world of money. See you in the next video. The evidence is there, hidden in plain sight. What do you think? Let me know your thoughts in the comments below. If you found this as fascinating as I do, make sure to hit that like button and subscribe for more deep dives into the universe's greatest mysteries. Interestingly, gold, the traditional safe haven asset, is actually down almost 2%, trading around $4,566 an ounce. Usually in times of uncertainty, gold shines. But right now, a strengthening US dollar is making it less attractive to foreign investors, which is putting pressure on its price. So we've thrown a lot of terms around. Let's quickly demystify the futures market itself. Think of it as a massive, organized marketplace where people agree to buy or sell something like oil, gold, or even stock indexes at a set price on a future date. These aren't just casual agreements. They're standardized contracts. For example, one crude oil contract is for exactly 1,000 barrels. This standardization is key because it makes the contracts easy to trade, ensuring lots of buyers and sellers, which we call high liquidity. One of the most powerful and riskiest features of futures is leverage. You don't have to pay the full price of the contract up front. Instead, you put down a small deposit called an initial margin. This acts as a good faith deposit to ensure you can cover potential losses. But it also means small price movements can lead to huge profits or losses, which are settled every single day in a process called mark-to-market. If your account balance drops too low, you'll get a margin call asking you to deposit more funds to keep your position open. There are two main types of players in this market: hedgers and speculators. Hedgers are businesses trying to manage risk. Think of a farmer who sells wheat futures to lock in a price for their future harvest, protecting them if prices fall. Or an airline buying fuel futures to protect against rising jet fuel costs. Speculators, on the other hand, are in it to profit from price changes. They have no intention of ever taking delivery of 1,000 barrels of oil. They are simply betting on whether the price will go up or down. Both groups are essential for a healthy market, providing liquidity and helping with price discovery. The Commodity Futures Trading Commission, or CFTC, is the regulatory body in the US that oversees all this activity to ensure fair play. So looking ahead in 2026, what are the big trends to watch? First, the energy shift. A brand new Nord Pool power futures market just launched this month. This will allow traders to manage risk in electricity prices across the Nordic and Baltic regions, a market that's becoming increasingly important. Second, the risk of stagflation. This is the nasty combination of stagnant economic growth and high inflation. Analysts are warning of a stagflation-light scenario, where soaring energy prices from the Middle East conflict keep inflation high, while simultaneously slowing down the economy. Central banks will have a very difficult tightrope to walk. Finally, the AI boom continues to be a major theme. Despite the broader market downturn, earnings from the Magnificent Seven tech giants are a huge focal point. We're seeing massive volatility in micro Nasdaq 100 futures as investors constantly reassess the true value and future potential of artificial intelligence. One day, it's the savior of the market. The next, it's a bubble. So there you have it, a snapshot of the volatile but fascinating world of futures in March 2026. From geopolitical chess to the AI revolution, it's all reflected in these market movements. It's a complex landscape, but understanding these key drivers can help you make sense of the headlines. When you hear the market, what comes to mind? For millions of investors, it's the S&P 500. This single number tells us the health of the US stock market and, by extension, the broader economy. But have you ever wondered where this powerful index came from? It wasn't born overnight. Its story is a fascinating journey of innovation, mergers, and technological leaps that spans over a century. Let's rewind the clock and uncover the origins of the S&P 500. Our story begins not in the 20th century, but way back in 1860. A man named Henry Varnum Poor founded Poor's Publishing. His mission? to bring transparency to the biggest industry of the era, railroads. Think of it as the first attempt to systematically track and provide financial data for investors. For decades, this was the standard for financial information. Fast forward to the early 1900s, a new player enters the scene. The Standard Statistics Company, founded in 1906. As the American economy boomed, investors needed a better way to gauge the market's performance beyond just a few big names. So in 1923, Standard Statistics launched its first stock market index. It wasn't the 500 we know today. It was a weekly index tracking 233 companies across 26 different industries. This was a huge step forward, giving a much broader view of the market than ever before. But the Roaring '20s were moving fast, and investors needed information faster. A weekly update just wasn't enough. So only 3 years later, in 1926, Standard Statistics introduced the S&P 90. This new index was calculated daily and included 90 of the largest U.S. stocks, 50 industrials, 20 railroads, and 20 utilities. For the first time, investors could get a daily pulse of the market. This became the go-to benchmark for over 3 decades. The next major chapter unfolds in 1941. In the midst of World War II, a landmark merger took place. Poor's Publishing and the Standard Statistics Company joined forces to create the company we know today, Standard & Poor's. This fusion of two financial information powerhouses set the stage for the next great evolution in market tracking. They have the history, the data, and the expertise. Now they needed to create an index that truly reflected the modern American economy. That moment arrived on March 4, 1957. This is the official birthday of the S&P 500 as we know it. Standard & Poor's launched the S&P 500 Stock Composite Index, expanding from 90 to 500 companies. This wasn't just about adding more stocks. It introduced a revolutionary concept, market capitalization weighting. Instead of treating every company equally, the index gave more weight to larger companies. This meant the index's movements would more accurately reflect the true value shifts in the market. At its launch, the S&P 500 was a behemoth. It represented over 90% of the total value of all stocks on the New York Stock Exchange. The largest company in the index back then? American Telephone and Telegraph, what we now know as AT&T. But what truly made the 1957 launch a game-changer was the technology behind it. For the first time, electronic computers were used to calculate and publish the index value in real time throughout the trading day. Before this, calculations were done manually, which was slow and cumbersome. This technological leap, powered by a company called Melper, Inc., meant investors could watch the market's heartbeat second by second. It was the dawn of the digital age for financial markets. The S&P 500 didn't stop evolving there. In 1976, it underwent another major update. As the financial sector grew in importance, the index was restructured to include a dedicated group of 40 financial stocks, alongside 400 industrials, 40 utilities, and 20 transportation stocks. This ensured the index continued to be a true mirror of the American economy. So the next time you see the S&P 500 tick up or down, remember the long history behind that number. From providing data on 19th century railroads, to using real-time computing to track 500 of the world's most influential companies, its journey is the story of modern investing itself. It's a testament to the constant drive for better, faster, and more accurate information. Have you ever wondered what fintech is? You probably hear the term thrown around a lot, but what does it actually mean? Well, fintech is short for financial technology, and it's all about using technology to make financial services better, faster, and easier for everyone. Think about it. From the moment we started using digital money, we've been on the fintech journey. So what's the big deal? Fintech companies have a few key goals. First, they want to streamline everything. Remember waiting in long bank lines? Fintech aims to make those processes quicker and more secure. often with just a few taps on your phone. This leads to incredible accessibility. Need to check your balance at 3 a.m.? No problem. FinTech services are available 24/7, right from your pocket. Another huge benefit is cost reduction. By operating online without expensive physical branches, FinTech companies can pass those savings on to you with lower fees. This is a game changer for financial inclusion. It helps bring banking, credit, and investment opportunities to people who might have been left out of the traditional system before. Behind all this magic are some powerful technologies. Artificial intelligence, or AI, is a major player. It's used for everything from detecting fraud to giving you personalized investment advice. Then there's blockchain, the super secure technology behind cryptocurrencies like Bitcoin. It allows for transparent and decentralized transactions. Of course, we can't forget mobile apps. They're the main way most of us interact with FinTech services today. And finally, big data helps companies analyze information to better assess risk and offer services that are perfectly tailored to you. You're already using FinTech every day, probably without even realizing it. When you send money to a friend using Venmo or PayPal, that's FinTech. If you bank with an online-only bank like Vero, you're using a neobank, which is another part of the FinTech world. Ever heard of robo-advisors like Betterment? They use algorithms to manage your investments automatically. And yes, the entire world of cryptocurrency and exchanges like Coinbase is a massive part of the FinTech revolution. The innovation doesn't stop there. It's also transforming insurance with InsurTech and helping companies navigate regulations with RegTech. From simple payments to complex investments, FinTech is fundamentally changing our relationship with money, making it more accessible, efficient, and personalized for all of us. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more content just like this. Ever thought about becoming a stockbroker? Well, there's a huge hurdle you have to clear first, and it's called the Series 7 exam. So what exactly is it? Officially known as the General Securities Representative Qualification Examination, or GS for short, the Series 7 is the primary license you need to sell most types of securities in the United States. It's administered by FINRA, the Financial Industry Regulatory Authority. So what does this beast of an exam look like? You'll face 125 scored multiple choice questions over a period of 3 hours and 45 minutes. To pass, you need to score at least 72%, which means getting 90 of those questions right. The cost can range from about $245 to $395, depending on the current fees. Now there are a couple of key requirements you need to know about. First, you can't just decide to take the Series 7 on your own. You have to be sponsored by a FINRA member firm, which is usually your employer. Second, you also need to pass another exam called the Securities Industry Essentials, or C. Most people take the C exam first because it doesn't require sponsorship and covers the foundational knowledge. Once you have that Series 7 license, what can you actually do? It gives you the authority to sell a wide range of products, including corporate stocks and bonds, options, mutual funds, and variable annuities. However, it doesn't cover everything. You won't be able to sell commodities, futures, real estate, or life insurance with just this license. Those require separate certifications. Let's be real, is this exam hard? Yes, it's considered one of the toughest in the financial industry. It's not about memorizing facts. It's about applying complex concepts to real-world scenarios. In fact, nearly 3/4 of the exam focuses on your ability to make suitable investment recommendations for clients. Most people spend between 80 and 150 hours studying for it. The pass rate is estimated to be around 65 to 70%, so a significant number of people don't make it on their first try. If you fail, there's a waiting period. You have to wait 30 days before you can try again for your second and third attempts. After that, the waiting period jumps to a full 180 days. So preparation is absolutely key. If you're heading down this career path, The Series 7 is a non-negotiable step. It's a challenging but essential gateway to becoming a registered representative. Thanks for watching, and if you found this helpful, be sure to like and subscribe for more insights into the world of finance.